folks, it's Dave Burrows, and welcome to Barometer's weekly Tuesday afternoon webcast. I'm coming to you from snowy Calgary, Alberta today. I came out to the west yesterday, was in Winnipeg. Apparently it snowed overnight in Calgary, so of course I didn't bring a coat. I bought 3 coats here in Calgary over the years as snow comes at inopportune times. I've decided to jump on just for first sort of 10 or 12 minutes today to whip through a couple of quick things. You are in the very capable hands of Diana Avigdor, our head of trading, who's going to carry on from there. And she may have James Callahan, I think, on as a guest somewhere along the way. So she'll jump on in a minute. But in the interest of time, I'm gonna jump in. It's a very interesting market. Some macro themes playing out that I think are counter to some thoughts that many people have. So we want to talk about that a little bit as we move along. So most people know we think we're in a structural bull market that started in 2013 when we exceeded the 2000 highs. We've had 2 great bull markets since 1981 through 2000, which had a series of long rallies and with some interruptions. And since 2013, same for the S&P, some interruptions along the way, but in general, the market has been taking 3 steps forward for 1 step back. A statistic I used last week, we are now 2 years into the bull market. October of 22 was the bear market low in the 2022 bear market, 25% decline, 26% decline. We're 2 years in, and if you took every bull market since 1950, if a bull market got to 2 years of age without reversing by 20%, on average, the bull markets lasted 5 years before they had their next 20% correction. So we don't use those statistics to make decisions, but it is interesting that a strong 2-year start tends to mean that the bull market will have above average longevity. So here we are now, a couple of weeks from the US election, and markets have been remarkably stable. Another statistic has been that if the market was able to stay stable through the difficult period, end of August through the middle of October, again, tends to have a very strong fourth quarter. We'll see. But what we can see is the market's been making a series of higher highs and higher lows. And after the little wobble in August, about 10%, marched on to make new highs. We talked about the fact that the equally weighted S&P 500 since July has been outperforming the market cap weighted. That's positive. That means that lots of stocks are doing well. The average stock is doing better. And we've also talked about the fact that when we look at the NASDAQ 100, it has been not quite as strong. It peaked in July, had a 16% pullback, and has chopped since then. It is higher, but has been unable to make a new high. And now technology is underperforming several sectors on the year. So we think that's important because a lot of people are concentrated in technology, a lot of big names everybody owns, and we own some. We have about 12% exposure in technology, and there's some wonderful companies, some of them behaving really, really well. But it's really great to see that there are other things to do. Now, this is a chart I put on Twitter this week, and I just wanted to touch on it. It's a chart of an index called the Value Line Geometric Index. It's not terribly different than the equally weighted S&P 500 in that it is about 2,900 companies, almost all major US companies, big and small, equally weighted in an index. And so again, this is measuring the average stock. And you can see that when the bull market started in the US in 1980, it really outperformed and performed well for a long time. And then we went into the bear market that started in the big stocks in 2000. It topped out in 1998 and basically has been in a range ever since until we got to 2020 when inflation started to pick up, the economy started to strengthen, and we had a first big leg higher. Now, I thought this was really interesting at the time because this is a very long sideways bear market. Now, since then, of course, we've been through a global tightening cycle, lots of stocks consolidated, especially smaller ones because they tend to have more debt. Higher rates make a big difference. But I just wanted to highlight, even though it's not glaringly obvious here, we have now made a 2-year high in the value line geometric index. And as I often say, after a market's gone sideways for an extended period of time, when it eventually does make new highs, it generally is the kickoff of something that will go on for a long time. If we go back here, we made a new high, we consolidated, and then the market took off. So I think that's interesting. It's just a sign that the average stock is improving. It means that there's lots of strength out there. It's not just a few big names. And when we look at global equities, what I'm highlighting here is if we take all the major geographic regions of the world and put them on a distribution curve based on the percentage of stocks that are performing well, you can see a lot of green. That means all of these regions are seeing expanding breadth. So great to have one sector doing well. Good to see more sectors doing well. Good to see one market doing well. Even better to see a lot of markets doing well. This says the equity asset class at this point is in very good shape. We are getting contributions from a lot of geographic markets. And we've talked about the fact that we're seeing strength in large companies, mid-sized companies, small companies. We're seeing some growth stocks still do well. We're seeing some value-oriented sectors do well. It's a healthy market. Now, when we look at the Canadian market, we said before, it looks a lot like global stocks, and look at the Canadian market. Canadian market's now outperforming the US stock market over the course of the year. And that probably has to do with the fact that there are some big sectors that are really performing well, like financials and industrial companies, materials. Even the energy companies in Canada are performing better than US because they tend to have long life assets as opposed to shorter duration shale oil and gas companies. So certainly good for our local investors because we do tend to own some Canadian stocks and some US stocks. Now, moving on, we thought that we saw generational low in interest rates in 2020. And effectively, what we were saying is we went from a disinflationary world where every time they raised rates at the Fed, you choked off growth, and we went to successively lower and lower yields. This change, we thought, was a sea change like the one we saw in the early 1950s, where you went into a world that was a reflating world. When we look at yields, we've seen now a series of higher highs and higher lows, including recently, we did pull back in yields starting last October, but we've had a sharp increase in bond yields over the last month. Now, there's lots of reasons for that. There is concern in the marketplace that governments around the world continue to spend way above their means. The US has been adding almost $1 trillion in debt, every 4 to 6 months. They paid just about $1 trillion in interest payments over the last 12 months. And in the month of August, with $320 billion worth of tax receipts, they spent $688 billion. And the market's taking notice. There is concern that central banks are causing risk of higher long-run inflation. And that's showing up in some of the asset classes we look at. So this is the long end of the US bond market. This is the bear market we saw up until October 2020, and we did bounce. But really, this bounce is not making any ground. All the moving averages continue to move lower. And the TLT has moved down from about par to about $90 over the last short while. So that's a concern. That's a market signal that maybe even though the short-term rates are coming down, long-term rates may not come down as we had hoped. Mortgage rates in the US got to as low as 6%, but they've backed back up to about 6.8 or 6.9. That has an impact. So our strategy has been, with the risk of higher inflation longer, to own dividend growth stocks as opposed to fixed income. We want a rising stream of income to offset a rising cost of living. I saw a commentary this past week that if you calculated the inflation rate in 2021 at its peak using 1980s conventions, inflation peaked at over 18%. And that currently inflation by those measures would be closer to 6% than 3%. So a fixed income rate of 4% isn't very attractive if we thought that the real inflation rate was higher. And so you can understand why investors have been working their way into dividend growth stocks, and why dividend growth stocks, it's all supply and demand, have been marking their way higher over the last 18 months. In our income portfolio, we are focused on getting a yield at a substantially discounted multiple versus the market, but the dividend growth rates have been far in excess of the S&P, and that's why the income strategy has been performing very well. But I want to touch on another market signal. Commodity prices, we know when bonds started falling, commodity prices started rising. This is an asset that benefits when there's inflation. And during the period where the central banks were tightening, really, commodity prices didn't drop. They went sideways and have recently started to rise again. And so you've got bonds starting to sell off again and commodities starting to rise now that we are seeing the central banks become looser with monetary policy. It may be that they don't have the resolve to really truly fight inflation because they need growth in the economy for tax receipts. So gold has been a big topic recently, and I almost was apologetic about talking about gold earlier in the year because, well, it's an asset class that not many people have made money in over the last 15 years. But when we see a shift, we have to recognize it. So a number of months ago, these are monthly bars. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 months ago, gold started to break out in price. And I think, you know, we own this in our macro portfolios. We own gold, some gold equities in our equity portfolios and income portfolios. And it has been marching higher ever since. So the question I'm getting right now is, well, it's come a long way. You know, our equities that we've been in through the course of the year are up 75-ish%. Is it getting overdone? So I wanted to just start in on the call today and just talk about this briefly because we've been doing a lot of thinking about this. But one of the ways we look at what happens when a sector gets overbought is we track how the price is reacting relative to a long-term moving average. This red line is a smooth moving average of the previous prices from the previous 200 weeks. So first of all, we know we're getting into a bull market when the moving average is moving higher. It means the average price of the previous 200 days has been rising. It's a sustained rally. But eventually, we'll start to move away from the moving averages. So you can see we are currently, as of this afternoon, about 42% above the long-term moving average. And we talked about this when we were looking at semiconductors earlier in the year. If we go back and look at the last bull market after long saucer-shaped bear market and a consolidation, very similar to this saucer-shaped bear market and consolidation, the first leg of that bull market went on and peaked at 85% above the long-term moving average. We are currently 32%. That's almost 50% higher against the moving average. Now that's one leg. Then the market corrected. It corrected for 18 months. In the second leg of the bull market, again, it peaked out 83% above the 200-week moving average. Then it corrected. A long-term bull market has corrections along the way, just like stock bull markets do. And in the third leg, which is typically the strongest, it wound up at 78% above the moving average. But by then, the trajectory of the moving average is moving higher. So when you add it all up, gold was up 345% between 2004 and 2011. That's a big move. Now, so we're sitting right now 32% above. So I would say that based on this, and we don't make long-term decisions on this, we look for change. And if there's change, we act on it. But I would say that 32% above the moving average is very early stage bull market. And you can see it in the way that people are behaving. They're only just over the last couple of months gone from selling gold to buying gold. Now let's look at silver, because silver is an interesting animal. It's highly correlated to gold. It tends to start to work later, but it does tend to have higher beta or higher volatility. It does tend to have a more accentuated move. You can see that over the last number of months, again, we broke out of a long range consolidation. We're sitting now 42% above the long-term moving average. Let's take the lens back again. Now, I'm going to look at the bull market of the early 2000s, like we just did in gold. The first leg higher would end up 82% above the long-term moving average, the second 134%, the third 114%, and the last one 150% above the long-term moving average. Again, this pales in comparison. But if we really want to go back and look at our bull market in precious metals, you have to look at the period of the 1970s to 1981, where gold peaked at $1,000. In the first leg of that bull market, it wound up 216% above the long-term moving average, and in the blow-off top, 500% above the long-term moving average. Now, we are not in the business of predicting anything. We're in the business of recognizing a change and dealing with it. Our job is to get into strong securities or strong assets that serve a purpose. If we're in an inflationary environment, these assets serve a purpose. They are a hedge. As I mentioned, gold has been less volatile than a treasury bond for the first time in 45 years. It's been more consistent. But I do think we have to understand the range of possibilities, and I think that this is relatively important. So what could drive it? We talked over the course of the week about the fact that Samsung has a new battery for EVs that ranges 900 kilometers, roughly double the current batteries. They charge in 9 minutes, but they take 32 ounces of silver to build them. Maybe that's something. We know central banks are adding both silver and gold to their reserves, but we think that this is a big issue. This expanding deficit, and we take out the pandemic years, but this trend is not getting better. US at a $1.8 trillion deficit this year. So let's look at inflation's killer in 1981, what Alan Greenspan had to say about deficits and gold. In the last significant bout of inflation, he said, deficit spending is simply a scheme for the confiscation of wealth. Gold stands in the way of this insidious process. The abandonment of the gold standard made it possible for welfare statists to use the banking system as a means to unlimited expansion of credit. In the absence of the gold standard, there's no way to protect savings from constant confiscation through inflation. So he said, gold is a currency. It is still, by all evidence, a premier currency where no fiat currency or paper currency, including the dollar, can match it. So we'll see. But I do think that this is interesting. I do think it's important to understand things that have happened in the past. And, you know, treasuries are more volatile than gold. Gold is providing a hedge. And, you know, again, I put this up earlier in the fall. At the end of the previous major precious metals bull markets, precious metals make up significant portions of people's portfolios. And as it sits midway through 2024, the average portfolio about 1% precious metals. So it's been the best performing asset this year. Of course, we'd always love to have more of it, but we are very careful not to overweight. I think that across the firm, we're about 8% precious metals. And that likely will grow as prices move higher. But this is certainly a story to watch and something that's important. So I won't take any more time this afternoon. I'm going to pass things on to Diana. But these gold stocks are acting well. Kinross, I think, is up about 80% on the year. Relative strength has been working its way higher. Agnico Eagle, which is a senior producer, 11 mines, geographically diversified, is up 73% of the year. Alamos Gold, which is an intermediate that we own, up also about 75%, making relative strength new highs. So they are contributing. It's one contributor to portfolios, and we'll continue to watch. So with that, Diana, I'm going to pass it on to you. I've got another meeting here in Calgary I got to run down to. I'll see everybody next week.
Very happy that we got to have Dave on for a little while. Some of our themes have overlapped, so I'm going to skip on those. I'm Diana Victor, and I'm the head of trading, and I'm broadcasting from our trading desk. I'm going to go through some of the markers that we're watching short term and tie it in with what we were doing in the portfolios. Not much has changed, but some stuff has changed. Bottom line still, and what we are most mindful at this point is capital preservation, but gains preservation. in the portfolio so far. 2024 has been very good to us, and we are working very hard to keep it that way. Markets have been in a new setup, that of lower rates, and not only that, but especially in the US and Canada to some extent, central bankers are cutting rates into a growth environment, and not because they need to restart the economy. That is special. So let's begin, and I will walk you through our thought process these days, and how the portfolios reflect that. I did have this, but Dave has gone through. I would just reiterate that this chart shows that markets have a 14 and 19 and some 22-year cycle, but and some are arguing that our bull market started in 2013, but arguably it reset when COVID happened. And if you don't believe that, then some people actually think that the new bull market started 2 years ago. So we don't predict. We'll let the market dictate the direction, and we will not go against it. So let's see what the market's telling us. This is the S&P over the last 10 days. It's up, but it flattened. It is earnings season, and that is very important. This is not atypical. During earnings season, the market tends to lack trend, as the headlines are idiosyncratic and unique to the individual company earnings. The further in we go into the earnings season, the more trends become evident, and the market is able to start pricing those in, but we're still in early days. This week and next, we will get the bulk of the S&P 500 earnings, and then Canadian earnings are a little more delayed. Macro tends to take a back seat when micro is at the forefront. This is the longer term chart of the S&P, and at the risk of sounding like Trump, it is a beautiful trend, making new highs. If I asked you 2 years ago, would you predict this? When inflation was spiking and hit 9% in the US, and rates were being ratcheted up at the fastest pace in history, a majority of us would say no way we'd be making new highs, and that inflation would be at 3%. We would say that recessionary for sure. And we wouldn't predict that the Fed is cutting rates into new highs. And this is why we don't predict. Markets rhyme, but they are never exactly the same. This is the chart of implied probability of US recession as priced in by the S&P 500 index measured by JP Morgan. And as you can see, it is virtually at zero after being at almost 90% between 22 and 23 as rates were moving upwards. Regarding predictions, I just saw this the other day and I chuckled because it's not the first time I've seen it. This is a list of 29 market strategists. These are predictors of the market. At the beginning of every year and throughout the year, they calculate where the S&P will be at the year end based on all kinds of great calculations, and they're very smart people. Yet 24 of 29 strategists have gotten it wrong so far, and the market is above 21 predictions of the 29. Only 5 are left that are still above where we're trading right now, closed at 58.87. The next one is 5900 by Oppenheimer. So it happens more often than not, and so it pays to listen to the market and predict going forward. There's always a reason to sell. I thought this was, I chuckled also when I saw this. There's always a reason to worry, but guess what? That's okay because markets climb walls of worry, and having something to worry about makes sure that we are concerned first and foremost with risk-adjusted returns. Returns are, if the market's up and you got it right, you have returns, but risk-adjusted returns are a little more difficult to achieve. And, tying it into what Dave said about gold, we do have 8% gold and the Canadian index is higher. S&P is lower, but gold is volatile. And so when you try to weigh it, you weigh it also according to its volatility to make sure that you don't introduce unreasonable volatility into the portfolio, yet still have the right kind of exposure. As markets climb walls of worry, in the trading desk, we see flows have been positive. Asset managers and leverage funds have increased their exposures to U.S. equity futures as reported by the CFTC. And Goldman Sachs calculated for us the amount of flows that are expected to come into the market in the new year 2025. Buybacks, we've been talking about this a lot, have been an important supporter of the market. In 2025, corporates will be the largest source of equity demand. We expect corporations will be net buyers of $1 trillion in equities in 25. That's an 18% year-over-year growth. And we expect buyback growth to remain robust in 25, according to Goldman Sachs calculations. This is driven by strong S&P 500 EPS growth, and I'll show you a little later what we're looking at. Foreign investors will be the second largest net buyer of U.S. equities with $200 billion in demand. The strength of the U.S. dollar is one of the key variables in determining foreign investor demand. We've had a U.S. dollar appreciated about 4% in the first half of 24, as the U.S. economy was the most robust economy globally amidst Europe and China. But they also bought almost 345 billion annualized dollars in our North American markets. A little bit about earnings. I think I've shown this before, but although estimates have been coming down on the EPS and revenue side, which by the way is normal, analysts start out by having less accurate estimates in the beginning of a quarter, and then they come to be closer to reality as the quarter gets closer. Operating EPS margins, that is profitability, are expected to be high. I mentioned this before, companies do figure things out. They figure out their costs and expenditures and final pricing to be a profitable growing concern is what we are looking at. So let's continue looking at the action. This is NASDAQ, same picture as the S&P, up and then flat as we enter the earnings season. Financials, we've been talking about this a lot, have begun the reporting season, and they have done quite well. Our portfolios have a decent exposure to financials all year. And last week, we added a regional bank after not owning regionals for a long time. Per Goldman Sachs weekly prime brokerage data, U.S. equities were net bought for a second consecutive week and saw the largest net buying since December 23, driven by long buys and to a lesser extent short covers, macro products, that's ETF and index, but also single stock, with a current macro setup that is favorable, with the U.S. economy benefiting from resilient growth and cooling inflation. And stimulus levers are getting pulled around the world with rates being cut everywhere, and corporate America performs well. So banks reported stellar third quarter results with EPS upside driven by a combination of cost controls, better net interest margins, and healthy fee growth, advisory, trading, underwriting, and managements were pretty optimistic on the economy, calling it Goldilocks. So that was good for us. Just wanted to show you what the regional chart has done. That's the red. As markets moved in to price in the Trump presidency catch-up. So if you recall, when Kamala Harris came on board, she got a little popularity. And since then, the Trump side has been catching up. Regionals have rallied relative to the S&P. If you're looking for a theme around why, among other things, at a high level, some of the reasons might include the theme of onshoring that would benefit a regional bank. Domestic is a theme that might work under a Trump presidency, small cap versus large cap, lower taxation and such. On trading desks, when the street measures sentiment, they find it is generally going higher and flows are supportive of that theme, as I showed before. And this is about powerful data point in the market that is not trending due to earnings season. It gives some confidence about the future that should this truly be indicative, we can think that markets are in good shape and continue to work for us. Just wanted to show you, this is a chart that calculates the number of up days year by year, and 2024 is pretty much up there as one of the highest. It's been a pretty good year. I wanted to go into China a little bit because the money flows into China have been very strong, and it actually does play into the Canadian stock market globally, and specifically helpful for Canada because of our commodity tilt. China has begun to reinflate their economy after COVID. They have particularly faltered to grow after the end of COVID and remained closed for longer than anywhere else in the world, I think. This has cost them dearly in growth. Tariffs and onshoring isn't very good for them either. As a result, it is starting to become evident that the PBOC is trying to stimulate. We don't have full details yet, but they already cut one of their interest rates, and we expect more details to unfold in the coming weeks. Either way, flows have been turning powerfully positive into China, and if this is the beginning of something, it should provide a level of support for oil and gas, copper and iron ore, commodities which feature strongly in our Canadian stock market. So who needs Mag 7? Mag 7 is up in the white, and the S&P, the rest of the market in the blue. And you can see that while the Mag 7 have consolidated, sold off, came back, but like Dave showed, not quite taken out new highs, the rest of the market is making new highs. So breadth has been positive. Now, the technology stocks, as you can see of late, have come back, haven't broken out yet. And we have that we're ahead of earnings. And of course, these are the growth engines. We have re-entered our position in NVIDIA. We've talked about the NVIDIA story many times in this forum, so I will not repeat it. But I would just quickly say that we entered it opportunistically early last year, held it successfully until a little while ago when there was some concern about the feasibility and shipment of their new chip. And as the skies cleared on this, we re-entered, and now we'll see earnings are coming up in a few weeks on this name. Should be exciting. As of yesterday's NVIDIA, this was what was supposed to break up technically above 140, a level to watch, and it closed at 143.70. So earnings are highly anticipating, but they do come in a while towards the end of the earnings season. Healthcare has also been a sector that received flows of late. We are underweight healthcare. The flows have been everywhere: biotech, pharmaceuticals, healthcare providers. But this has been a sector that has still has low exposure. It's still only, excuse me, in the 12th percentile on the 5-year look back. So exposure here is low, and we have a few names, but not a top sector for us, rather a diversifier. With names that are exposed to the GLP-1 market. That's the weight loss market with a stock that has done very well for us, Eli Lilly. We've discussed in this forum before as well. This is the 5-year chart of Lilly just for visualization. It has been a segment of healthcare that has done very, very well. Novo Nordisk, Eli Lilly, etc. Curious about the earnings here as well. Gold, I did prepare these, so I'll go quickly. I know Dave has gone through it. All-time high, driven by policy and inflation. 2020 is a decade of US and global fiscal excess, no matter whether you're a Republican, Democrat, or otherwise. So I don't think the elections are going to affect this. Really, it's the threat of US dollar debasement, and Bitcoin is at all-time high as well. Dollar is pretty overbought. Despite the Fed cutting 50 beeps last month, the US dollar is holding strength because of weakness of other currencies, such as the yen and the euro. Their economies are in arguably a much weaker position, and their rate cuts have started sooner. So now the Fed looks to be catching up. Our portfolios are US dollar hedged, both from a tactical perspective, but also to take the currency volatility out of the portfolios and smooth out the returns. On central banks, and in particular Bank of Canada, will meet tomorrow. I have heard whispers of 75 beeps. I doubt it. I personally don't believe it'll happen. But I do know and respect our central banker as one of the best globally, and he's quite courageous. So it'll be exciting tomorrow morning. There have been what they call jumbo cuts, but I think they refer to 50 beeps. I think that's probably what we see tomorrow. This is a chart of Bank of America's private client holdings. They have certainly gone down over time as this market has been quite excellent, one of the most excellent ones in recent memory, and bonds don't hedge inflation, gold and equities do. Next, I want to talk about, always of interest to us here in Canada, is oil. Interestingly, oil has not acted well and has not been very worried about the geopolitical tensions between Iran and Israel. The narrative is that there is enough supply out there, and Saudi Arabia is saying that they will increase supply if necessary, but also nothing matters unless there are supply disruptions in the form of transportation issues, think blockades of tankers, or if the flow of payments can go through. Oil price will rise if there will be supply blockages or economic growth or China. For us, for now, this has been a source of funds, though we still have an allocation in the portfolio to energy, but we sold CNQ. And this is not an energy company, but copper rather. We also sold Freeport to buy a regional bank, Regions Financial. We sold Freeport to zero last week. Our thesis on copper remains unchanged, but Freeport had a fire at their copper smelter in Indonesia, which could prevent some issues with their ability to export. As said, we added a regional bank to our portfolio last week, Regions Financial. This is the first time we owned a regional bank since early 23, as the space has gone through an extended period of underperformance, given that the direction of the US economy has been in question and the acute issues surrounding the collapse of First Republic Bank and Silicon Valley Bank still loomed. But with rates moving lower, the risk of similar issues has become negligible. The US economy now is unquestionably strong with new pieces of confirmatory data coming each week. The time seemed right to add a regional, and the choice of Regions Financial is due to their favorable geographic footprint. Southern states, Texas, Midwest, these areas exhibit higher growth metrics, immigration, reflation, benefiting the Midwest and Southern states, and more attractive regulation. And they also reported last Friday and beat nicely. In 2016, regional banks outperformed post-Trump victory. I mentioned before some of the reasons why. It seems like there's more to this than repositioning, but it helps. This is Bank of America private client flows and allocations. Municipals, of course, are the largest, but those are tax efficiencies for Americans. They are followed by dividend growers, which Barometer portfolios are very cognizant of, as mentioned also by Dave earlier, and utilities and materials. Equity holdings as a percentage assets under management are inching up, but not overbought. There's room to increase. People are not overinvested or maxed out, so we feel there's more room to go. Staying on the dividend theme, it's a theme that features strongly in our portfolios. A utility exposure we recently added to is Canadian Hydro One. It has a dividend yield growth of 5%. Particularly, it looks that Bank of Canada is going to do what they call those jumbo cuts, as I mentioned. It will benefit this sector. Staying on the sector and dividend theme, we also own Enbridge, 6.5% gross yield, growing at around 5%. So dividends and dividends growth, those are anchors. One of our additions has been AT&T, with rates coming down and an 8% yield and a significant amount of debt. This will just, their debt will just get cheaper, and the company looking to restructure. Investors are looking for commentary around EBITDA and free cash flow growth for 2025. These are the kind of companies that would benefit from a rate cutting environment with good economic growth. My last slide to you is a quick full visual and review of our portfolios. We haven't made a lot of changes in the portfolios with the exception of selling Freeport and buying Regions Financial. We're still overweight financials, underweight technology, overweight industrials, energy a bit overweight relative to the S&P, but underweight relative to the TSX and is a source of funds. Overweight materials, like we mentioned on gold, underweight healthcare, but very targeted in our exposure in names like Eli Lilly, and exposures and certain little different things depending on bottom-up stock selection, like consumer discretionary, some staple, and such. Really, they're diversifiers. And just making sure that we're not missing anything. And sometimes you do get from bottom up some really good companies. We are currently fully invested. with a negligible amount of cash, as is reflective of our view that with the broadening of breadth, markets can continue to trend higher, even in the face of the current pause, which is reflective of certain catalysts ahead, such as elections and earnings season. I hope I have given you some color about what we're doing and what we're thinking. Thank you for joining our market update webcast today. I hope you have a wonderful rest of the day in this great weather we're having, and hope to see you again next week, same place, same time. Please don't hesitate to contact us if you have any questions about this webcast or otherwise. I'll be happy to provide more details if I can, or research it and come back to you. All the best, and thanks for listening.